First of all, in today's market, the 10-year US Treasury yield rose to 3.876%. All three indexes are not doing very well. They are all down, especially S&P 500 and Dow Jones, who has dropped more than 1%. This is the US 10-year bond yield. It hasn't been to this highest level since 2010. The basic key lesson of this chart is that market interest rates and stock valuations have a seesaw relationship. Right now, stock prices are falling as the yield on the 10-year US Treasury note rises. It's not just the 10-year US Treasury yield. The yield on the 2-year US Treasury note is at its highest level since 2007. S&P 500 has been falling for 5 days in a row. It has finally hit a new low for the year on a closing price base and is far away from its 50-day moving average. This is S&P 500 AD line, which is also down quite a bit. So it's not just a few stocks, but the whole stock market is losing value. The Dow Jones price has broken cleanly below the low point since the beginning of the year. I think this line will become an upper resistance line in the future. Now the price has reached 20% below the recent high. NASDAQ is in a bear market, but this is still above this previous low. If you look at the price movements during the day yesterday, the NASDAQ was up more than 1%. When the market opened, it went up, but then it went down at the end of the day. This is called a fake rally that is often seen in bear markets, where a stock shows strength in the early going, but then loses buyers at the close. So today's sentiment: first of all, the fear index finally broke through 30. Here's the chart of VIX from 2000. And here is where we are right now. Of course, there have been many times when the VIX has jumped above 30, but not that many. So this is not a normal situation. The equity put-call ratio rose to 1.02 yesterday, but now it is down to 0.8. If this is above 1.1, it's usually said to be a buy signal. This trend reminded me of this phrase: bear markets slide down a slope of hope. The P500 chart once again shows this very well. After a decline, the stock price rises a little and investors have hope, but then it falls further. Then the investor buys more and hopes again, and then it falls further. They buy more again, and then it falls further, and then they buy more, but then it falls again, and the bear market rolls down this slope of hope. At the end of the day, investors get tired of this repeated deception and exit. I think you all already know by now that the occasional bear market rally is not a buy, it's a sell. Why are you always so bearish? But I am not always bearish, of course. For example, on March 28, 2020, there was a tweet: "I am like a kid who walks into a candy store holding a $100 bill, eyes blazing." In other words, there were lots of stocks to buy. March 28, 2020 drop was caused by the coronavirus pandemic around the world, and then the prices went up a little bit. Black Monday of 87 was another great opportunity, and then the bear market that started in 1990 when the Gulf War broke out, when the dot-com bubble burst. Looking back on the Lehman Brothers collapse, it was also a great opportunity to invest. And of course, the decline caused by the coronavirus in 2020 was also a great opportunity. So what about now? The market may be a bit confused now, but it's still not in a turmoil. In other words, I don't think there are enough shocks in the market yet. Here are the numbers that you should definitely keep in mind. The bear market drops in the past. Looking at this year, the S&P 500 is still down 23% and the NASDAQ has fallen more than 30%. If you check since 1970, when the biggest commodity price shock in 50 years happened, 1973 and 1974 were the two consecutive years when the NASDAQ fell over 30%. Then the dot-com bubble burst. In particular, the year 2000 saw a 39% plunge. Then came the bankruptcy of Lehman Brothers. At that time, it dropped 40% in 1 year. Today's sector-by-sector performance shows that almost all sectors are negative, but in particular the energy trading and real estate sectors are down more than 2% since the beginning of the year, and the energy sector has been the hardest hit this month, down more than 13%. But the energy was in great shape in the first half of this year, so be sure to keep in mind the sector performances here. Looking at just this month alone, the smallest negative movements are in the utilities sector, consumer staples, around here, and healthcare. In other words, investors are following the textbook so far. If you liked the video and want to watch the next one, be sure to subscribe to our channel and smash that like button. If you have any questions or suggestions, post them in the comments below.